Hello. Thanks for stopping by. Thanks for checking out this video, spending some time with me. I thought I'd spend a few minutes. I just talk about the bond market. I know there's a lot of chatter about interest rates, about the Fed activity in the bond market. We have the big jobs report on Friday that will be a market mover. We're all wondering what's going to happen. I want to share a couple of articles that came out in the last day or two, and then I want to share some thoughts, just give some perspective of where we're at. Now, the first article I want to share today is from Bloomberg. It's why long and short interest rates have fallen out of step, meaning they're no longer tracking one another. It's unusual what they're doing. The long end of the curve has separated from the short end of a curve. Now, some people would say we're starting to get to a natural separation, but the way that they're behaving is unusual. Now, what's driving this is the fear of future inflation, the massive supply of bonds coming to the market, uncertainty, all that's driving it. And what you have to keep in mind is that the Fed can control the short end of the market, the overnight cost of funds, even short-term duration bonds. The market, though, dictates the yield on the long end, and that is what bond buyers are willing to pay, the yield that they want, right? I will buy your long bond, your 10-year treasury, your 30-year fixed rate mortgages, but I'll only do it at the interest rate that I want. That's driving up, that's putting upward pressure on interest rates. So I think even a better article to show than this is a newsletter from Dr. Torsten Slok from the Apollo Chief's economist. If you follow me, you know I love this guy. I totally love this guy. He came out, as you can see, I think it was Monday, with this on his newsletter about, hey, here's how the 10-year treasury typically behaves in the face of Fed cuts to overnight cost of funds, and that you can't see it because you really can't see it great on my screen. But if you could see my screen perfectly, you would see that the red line, which is the current, loosening cycle, that the 10-year bond is really behaving differently. It's not tracking previous Fed cuts, which is all super interesting, right? And then what I really would want you to do, and I'll put links to these two articles below. The Daily Spark is not behind a paywall. The Bloomberg may be behind a paywall. With any of my posts, you can always ping me if you can't get the article. I'll send you a copy. Just DM me or email me or text me, and I'll send you a copy. I also want to just direct everybody. I wrote a lengthy article. I think I posted it this weekend. What if interest rates are as low as they're going to be for the foreseeable future? It's about a 1,000-word article where I try to explain the direction of interest rates and where I think they're going to be for the next decade and why. I quote at least 8 economists in that paper. Now, they're not the economists that we typically follow, so they're outside of our echo chamber. They're outside of our biases, and so we're going to get some feedback that you and I typically don't necessarily embrace, but I'm trying to do a good job just getting some good feedback. So, with all that, here's the thing. Interest rates, long-term interest rates are being super stubborn right now. I think Barry did a really good job today on his podcast saying that we're at an inflection point, that if the 10-year bond goes above that ceiling right now, that we're most likely going to see a pretty significant increase in interest rates. To me, it really doesn't matter. I think consumers are getting used to interest rates in the high 6s, low 7s, more inventories coming to the market. I'm going to talk about this probably tomorrow. More people are getting interested in selling their home. More people are getting interested in buying a home. Home buyers are getting more comfortable or more used to that 6%, 7% interest rate. We're probably going to have a pretty good year at $2.3 trillion in volume. Now, that's the forecast. I think it might be a little bit less, but call it 2.1, 2.2. Still going to probably make it the 7th, 6th, or whatever, 5th best production year we've had in 20 years. Not all bad. If you take the 2.1, $2.2 trillion in business with the amount of loan officers that are left in the business, there's probably more business for all of us than we've had the past few years. So it's going to be a good year. We just need to really help convince especially first-time home buyers, regardless of the rate, now is a good time to buy. You can afford it, and the house will be more affordable every day going forward. It's a great hedge against inflation. We'll keep talking about that in the upcoming days. I wanted to just make sure I got you some really good articles about interest rates when there's so much noise right now. With that, I hope you're having a really good start of the year. I appreciate you checking me out. I will mention I did do a very, not lengthy, but a pretty lengthy LinkedIn post today with links to these articles, and I summarized the ones just like I just did. So in case you want to go back, you can check it out on my LinkedIn. I said I did link to the articles there. I'll do links in my notes below. And if you can't get the articles, ping me. I'm happy to send them to you. With that, I hope you're having a great start to the week. Thanks for checking me out. Thanks for spending a little bit of time with me. I appreciate you. Bye.